The first thing I look at is their track record overall, and then what they're working on recently. Is it in alignment with the rest of what they've done? What is their overall record? That's very important.
Are you investing in phones at the beginning, or are you looking more to invest in more mature phones?
Generally more mature funds, unless it's someone that I know the operator or the fund manager, because I would probably, you're more investing in that person because you're taking the risk with that fund manager, and they're the ones that you're betting on, that if things aren't going quite as planned, they will step in and try to make things right and make manage the assets accordingly. Well, you have to stick to your plan, because real estate in general and investment anyway is a long-term strategy. So you want to make sure that things still fit within your criteria of what you're doing, and you want to make sure that you stick to that. And if it's close or it's out of it, you don't want to take that undue risk, because it will probably come back to hurt you later. So even if you don't buy anything for a while or don't invest for a little bit, if it doesn't fit your plan, don't do it. Don't follow the shiny objects and try to jump into the new things. I've done that, and I ended up losing a little bit here and there just because I lost traction in what I should have been doing. I went away from my actual plan of long-term strategy in real estate.
Tell me one thing that general partners should stop doing when pitching limited partners.
One thing is, don't immediately start pitching the deal or email it out. Get to know the person that you're, find out what they need. What you're trying to pitch them with may not have any relevance in their life. It may not be what they need, and listen to what they have to say. Listen to what they need. That would be, so stop just pushing the deal out on everyone until you get to someone. Try to attract the people that will be good for that deal and that will benefit from what you have.
Based on this information, did you invest in a general partner or founder without a financial track record? Did you use just your gut feeling that it's a good investment and you have to go into it?
No, I didn't, just because I think I have to do my own due diligence, and mine is might be a little more or less stringent than some people, but the main thing was that it was people that I'd dealt with in the past and had, it just depended if the relationship had been there for a long time, and the due diligence period would still be pretty heavy, but I would have more confidence, especially if it was somebody that I had a track record with or knew of their track.
For me, it's very important to have a personal brand as a co-founder or founder of a company.
Yes.
Is it important for you as well?
It can be. It depends on the business. Like the development partners we're involved with, they don't necessarily have a personal brand, but their track record is 3 decades. So it's not so much important in that case, but to develop that, and it will make investors feel a little bit easier if they know who they're getting invested with. It'll only accentuate the track record. But it can vary. But there's where, I've met people in person, and that really matters, the in-person, because building out your own personal brand, if someone does have a personal brand and you look and you can find out a lot about them, that will carry quite a bit of weight.
I know you are eager to get back to the conversation, but let me quickly share something that might be highly relevant for you. If you are a venture capitalist looking to connect with high-quality deal flow or build relationships with limited partners, we have built a platform just for you, vcroom.com. There, you will be able to engage directly with vetted startups and limited partners who match your investment thesis. And if you are a startup founder looking to raise capital and connect with top-tier investors, head over to vcroom.com and find the right VC for your journey. The platform goes live by the end of May, so this is your chance to join the waitlist and be among the first to get access. We can't wait to hear your feedback. See you inside the VC room. Hello everyone and welcome to the VC room. Today we are joined by Scott Kidd, owner of YACHT Real Estate, a multifamily real estate firm helping high net worth individuals invest in Class A properties. Scott's experience spans roles as a limited partner, general partner, and joint venture partner, with investments across Ohio, Florida, and North Carolina. Hi Scott and welcome to the VC room. It's a real pleasure to have you here with us. How are you today?
Very good. Thank you so much for having me.
It's our pleasure. Thank you for accepting our invitation. You had actually a real unique journey, and I would even say it's quite uncommon in the investment world. Tell us more about who Scott Kidd is.
Okay, well, I'm Scott Kidd. Been a yacht captain for the last 25 years, and I've been in multifamily real estate syndication for the past 5 years. Still a yacht captain. The last I work 6 weeks on, 6 weeks off, and I worked in the real estate realm pretty much every day, 365 days. I've been lucky enough to be a part of, as a limited partner, a general partner, and a joint venture partner in real estate deals, from smaller joint ventures with just a few partners in Florida, and North Carolina as a general partner, and now general partner in Texas, which are we're starting a fund in Texas as well, and I have some limited partner positions in Ohio, and I'm just really thankful that I was able to find these opportunities, and there's a lot of great things happening these days. I got to real estate just by happenstance because a friend of mine told me about it, and he had bought and sold some real estate, a 46 unit in Houston, Texas, and I asked him, you can do that, and he said, yeah, you can do that. Anybody can do it. I did it, so you should do it too. And that started my journey about 5 years ago.
Amazing. So I read some information about you on your LinkedIn profile, and you said the following: I have tried many things. Some worked out well, others didn't. But each step taught me something valuable. Tell us more about this. How did you struggle?
Well, the struggles come and go. That's life, but I think we all learn much more from the struggles than we do when things come easy. There were quite a few struggles. The biggest struggle was trying to figure out what my overall plan was and getting going, because I tried a lot of different things. I jumped from a lot of different asset classes. I was looking at mobile home parks, RV parks, self-storage, single-family homes, build to rent, investing in funds, but it all kept circling back to multifamily real estate, because I always figured there's a lot of loan products that are structured that are government backed, that help facilitate that, because everybody needs to live somewhere, and the government backs a lot of these loan products, and it's not like any other asset class. And I always figured a lot of people have to live somewhere, so there's always going to be a demand. And one of the biggest struggles was, trying to find the right partners. And I'd been in business before and done business before, and choosing the right partner. I've been fortunate in some ways and unfortunate in other ways where we weren't the right fit, and that caused a lot more struggles than needed to be, just because we didn't have alignment of interests, so everyone was not on the same page, so things got very messy at times.
Well, this is normal things that happen to entrepreneurs, and actually this question was for those which are more at the beginning, or they are thinking that being entrepreneur or even investor is amazing. And Yeah,
Yeah.
look at us. We struggle a lot.
Yes, still struggling at times, and but people think a lot of times that when you work for yourself, you're going to have all this free time, and you're going to go and do all this stuff, and you see people on social media that are traveling all over the place and working for themselves, but what you don't see is all the work, the 16 hours a day, sometimes 7 days a week, all day, for months and years on end sometimes, just to make things work. And if especially if it's you by yourself, if something goes wrong, you have to fix it. You have to find the solution. Not there's no one you can call, and a lot of times no one is going to help you.
That's completely right. When the people around me are asking me, how did you succeed? Or how did you accomplish so many things? I'm always telling them, I have failed more times than you tried. And this is actually
Yes,
what is
most
happening
definitely.
with all entrepreneurs. Well, so you are
Yes.
a real estate investor, limited partner, general partner, a lot of roles, which is quite a diverse portfolio. I would like to know what inspired that diversification and where have you seen the strongest returns?
The one I like the most is the limited partner, because if you choose the right operator or the right fund and right fund manager, you're a passive investor. You're not active in it, and if you've made the right choice and properly vetted the operator or fund manager, you will get steady, consistent returns without really doing a lot of work. You still have to manage and still know what's going on that aspect. That's about as much as you will have to do. But that one I would say is the most favorable for me. My end goal is to have multiple of those, and just keep receiving the returns and still build my own personal active portfolio, so that I can pass that on to my kids and my family, just so they learn the business and they know how to do these things, and know that these options and opportunities are available, because it's wide open on that respect. And that each one of these has some ups and downs. I like the joint venture as well, because it's smaller and less complicated. Less people involved. You don't have a large amount of investors. It's usually just a few people. But I like the general partners as well, because you get to work with a team, and it can be I would say very challenging, because you have to come up with a lot of different solutions at times, and it's very rewarding on the other end too, because you're putting a lot of work, and you do take a little more risk, but you also get a better reward. So my first would be investing passively, but I do like all of them, and they all have their benefits.
I completely understand. As an investor myself, I'm always thinking about making investment who can return me 10 times more without doing anything.
Yeah.
What kind of ventures have you chosen to invest in as a limited partner?
The majority have been real estate syndications and funds. I've invested into some REITs also, which are more kind of like stocks, but I like those because they give you a steady return, and if you vetted the operators correctly and done your due diligence, they generally work out fairly well.
Amazing. You told me that you have usually some questions that you address to the VCs when you assess them. Tell me, when you consider investing in a fund, what's the first thing you look at during initial conversation with the team?
The first thing I look at is their track record overall, and then what they're working on recently? Is it in alignment with the rest of what they've done? What is their overall record? And that's very important.
Are you investing in phones at the beginning, or are you looking more to invest in more mature phones?
Generally more mature funds, unless it's someone that I know the operator or the fund manager, because I would probably, you're more investing in that person because you're taking the risk with that fund manager, and they're the ones that you're betting on, that if things aren't going quite as planned, they will step in and try to make things right and make manage the assets accordingly.
I'm curious how these deals happen, and where is actually the beginning? How did you meet actually the general partner of the first fund you invested in? It was a cold approach, or I don't know. I would like to know if somebody introduced you directly to them, you met them since a while. How was it?
It was a relationship that had developed after a while. I'd met somebody, I joined a mastermind and a lot of different meetup groups, and I had learned that you have to just continually network to meet people, and try to provide some type of value in the operation to where you're solving a problem that they need. Like, for instance, if you're good at underwriting, you maybe be part of the team if you can underwrite really well, or if you're good at asset management and raising capital, you can come in and do those two things. It just depends. For me, it was asset management and raising capital, investor relations, those type of things. Because I found after a certain point, especially with the syndications and as a general partner, you cannot do it all. You have to know how to be a good part of a team, because you have to bring some type of value to the team, or else it doesn't really work. You cannot do it by yourself.
100%. But when you raise capital and when you talk with limited partners to attract money in your venture capital fund, at the beginning you may count on friends and family, but afterwards you have to go on the market with and talk with many more, even institutional investors. From your perspective, how do you convince them to invest usually? And I'm more interested in understanding how do you build trust in order to make them invest in you, of course, based on a track record or based on your know-how. But I would like to know exactly what are the steps that they should follow in order to build the trust.
Well, trust goes, both ways. You have to really trust that person first. And like any relationship, it takes a bit of time. A lot of people are depending on you to be the steward of their capital, and they've worked very hard for it. So, whether it's a LP investor or institutional money or, private equity fund or a family office or anything, depending on the relationship that you've had already, it can take quite a bit of time. Everyone is a little bit different, but the main thing that I've learned is you have to get to know what they're looking for, and that's what's the most important. Is a lot of people just keep spitting out a lot of different deals and stuff, and talking to a lot of people, but you need to get to know the person and find out where they are in their life, what their risk profile is, what they need. So fill their need. Once you find out what they need, then just find something that is in alignment with their interests, and then see if it's a good fit for them. And if they may not be comfortable with it at that time, but there's where also you need to keep on the education process and let them understand what they're getting into because if it's not something they really understand, then you shouldn't really have them involved in what you're doing, because they have to understand what they're getting into, because it could cause a lot of problems for them and yourself later on. You really want for them to trust you with that. You want to make sure that everything is clear and they understand what they're getting into, because if not, you're doing them kind of a disservice, because you don't want to just take money to take money. You want to build a long relationship. You don't want it to be just the first time. You want them to grow their capital, and you want to grow the relationship with them and build something for long term, because all of the good relationships are long term.
I 100% agree with you, Scott. How does it look a great emerging manager for you? To understand, how does it look a great emerging manager for you? General partner, I mean, a great general partner.
Oh, a great general partner. One that has a great track record, that is very communicative. That's another thing that's very important to me, that where they communicate. Because where they communicate with you in the beginning, that's how they will communicate you more or less all along. If they tell you the good, the bad, and the indifferent, like if things are going bad and they let you know, it's okay, you can deal with it. But if they disappear once you've given them money, that's a bad sign, because if things go bad, you're not going to hear from them at all. And the main thing is what I look for is that high level of communication, where if they say they're bringing monthly reports and you can call them every so often and check in, try it out. If it's after a couple of weeks, just, or after a first month, or they're giving you quarterly reports, hold them to it. Make sure that you get those reports at those times, and then check in with them if it's possible to go to some of the GP meetings where you can get some inside track. That's what helped me a lot to learn more about the process, was that I asked to be involved in some of the GP meetings, just to sit there and listen, because then you get to know all the inner workings of everything. And make sure that you do background checks on people. You ask around, ask them if you can ask some of their current investors what their experience are, and ask former people that they were involved with. Get to know the team. It's not just the sponsor. Make sure you vet the entire team, because there could be one bad link that could be a critical part of their operation that could cause a lot of problems for the entire operation.
All general partners should keep in contact with their limited partners, their investors. But you mentioned something pretty interesting, and I didn't hear about this so far, or at least none of the limited partners I know are doing this. So you want actually to be more involved and to participate to some gatherings of general partners. I would like to know, how does this helps you after you actually already invested the money?
Well, when I first invested in a limited partnership, I got to learn, how the property management worked, how they went about with the operations, on the day to day, how quickly I got to see how they were leasing up the property, how they were, moving forward, what their targets were for marketing, what their targets were to fill the vacancies, and just the overall plan. They set, clear targets and stuff. It was very good in that way, in that they allowed me to sit in on some of these meetings and stuff. And this was a particular deal that I had not even invested in, but they allowed me to sit in and listen, and just because I wanted to learn about it. And they said, well, no, we're open, we don't have anything to hide, which I think that is another plus, because granted, there are some things that need to remain confidential, but like tenants' names and residents, information and things like that. But learning all the inner workings of the business, it only helped me get better and understand the process and what to look for.
Based on this information, did you invest in a general partner or founder without a financial track record? Did you use just your gut feeling that it's a good investment and you have to go into it?
No, I didn't, just because I think I have to do my own due diligence, and mine is probably might be a little more or less stringent than some people, but the main thing was that it was people that I'd dealt with in the past, and had it just depended if the relationship had been there for a long time, and the due diligence period would still be pretty heavy, but I would have more confidence, especially if it was somebody that I had a track record with or knew of their track record.
Okay, so I do understand that your investments are more conservative and are based on your network, actually, right?
Yes, for the most part, other than my general stocks and stuff like that. That's pretty generic. But all my personal investments and business involvements, I believe they have to have a certain level of personal relationships with these people, so that if I figure if I can't eat a meal with someone, I don't want to do business with them.
Okay, I understand. Well, it's interesting to see your perception because, as far as I have seen, a lot of investors, of course, they make due diligence, they are assessing the venture capitalists carefully, but most of them are, I have seen that are more risk willing, let's say. In your case, I see that you are not so into risk, and you go more with the people that you actually know, and you know that they perform
Yes.
100% in the direction that you want.
Yes. Yes, and everyone is different, because when I'm investing other people's money, if it's my money, I'll probably be a little more risky myself in other people's deals. But if someone is trusting me to invest their money, I'm going to go a little more conservative, or actually probably quite a bit more, because if everything loses money, I'm going to have to find a way to get it back for them somehow.
So tell me more about this process. You are not investing directly your money, you mentioned. So I believe you are investing through your fund. Am I right?
Yes, we're just starting the fund, and I am planning to put my own funds in, because I firmly believe that if I wouldn't put money into it, then why should I be bringing other people's money in? Granted, there will be times where you get in real estate, you become at some point, property rich but cash poor. So it happens for a while, and then when the money turns over, you put more money back in. But I have to believe in something to put my own funds in and bring other people in.
Mhm. So your fund actually will become limited partners for other funds, right?
Yes, it will be fund of funds also, and limited partners, other joint venture partners as well. We're looking for the whole range of equity partners, because we have multiple projects going.
Mhm. So real estate and venture investing both come with risk. How do you personally approach uncertainty, even more nowadays when a lot of things are happening globally?
Well, you have to stick to your plan, because real estate in general and investment anyway is a long-term strategy. So you want to make sure that things still fit within your criteria of what you're doing, and you want to make sure that you stick to that. And if it's close, or it's out of it, you don't want to take that undue risk, because it will probably come back to hurt you later. So even if you don't buy anything for a while or don't invest for a little bit, if it doesn't fit your plan, don't do it. Don't follow the shiny objects and try to jump into the new things. I've done that, and I ended up losing a little bit here and there just because I lost traction in what I should have been doing. I went away from my actual plan of long-term strategy in real estate.
This is actually the right philosophy, but what I have seen in the past 2, 3, 4, 5 months, it was a kind of a weird situation. Most of investors are saying that, you have to follow your plan, but I would like to wait a bit more because, we don't know exactly what is happening.
Yeah.
So it's very interesting.
It's true. It's very hard to do, but like I tell them, it's hard to get in the game and get into a goal or something if you're on the sidelines. At the same thing, to use a reference for the sea, is you cannot catch a wave from the beach. You have to be in the water. So you have to be actively looking, actively pursuing, and if it does, still do the work. But if it doesn't work, it doesn't work. Don't try to make it work because you will hurt yourself. Still keep doing the work, but on the sidelines, I've faced that as well. There's a lot of investors still on the sidelines, but the ones that are more seasoned and have had decades of experience, I see them. They're still going. They're always going. They say they've been through multiple cycles like this, so they say no. We just keep going. If it fits, it fits. If it doesn't, we don't do it. And we just keep moving. I mean, you might have to analyze. A friend of mine, I think he said he analyzed 200 properties and then he found one. So, and that was, and one year I think it was 300. Sometimes you have to get to 1,000 to find one. But if you don't do that, you're not going to. Don't think you're going to just jump in and look at 5 and find one. It's pretty rare. You'll probably get hurt if you do that.
Amazing. I love your perspective. So this will be as an encouragement message to those venture capitalists I have talked in the past few months who actually faced a lot of issues when they approach investors. So keep going means that those investors are not for you. The one which are willing to keep going with their plan, they are on the market, and you just have to talk with them.
Yeah.
Okay.
Yeah, you just have to do the calls. You have to keep in contact with them, follow up, do the emails. Just keep going. The only way you succeed is if you keep going. If you quit, you will definitely lose.
100%. So, dear venture capitalists, keep going.
Keep going, everybody. Let's go.
Yeah, let's go. Now ahead, I don't know, in the next, let's say 5 years, not more, because we never know. Our perception change a lot in 10 years. How do you think the relationship between limited partners and general partners will evolve?
It'll evolve. I think there'll be, to me, with all of the AI things and a lot more communication, it'll be much easier to keep in touch, and it'll be easier to educate the limited partners because a lot of these investments, especially in the United States, were not necessarily available to a lot of different people. People did not know that they could become a limited partner and invest in a lot of these companies or real estate. And in the U.S., it was 2012 Jobs Act that they could actually advertise. So granted, you're advertising to accredited investors, but other things, you have to be very careful with SEC regulations and stuff. But I only see it getting better because now you can do automated reports, where they can see, or they're going to have better dashboards where people can see live what's going on, and you're going to be able to communicate better with the especially in real estate with the residents and with the investors. So, if you can make the resident experience much better, then if you have happy residents, you're going to have happy investors. And the same thing, if you have happy people working at a company, you're probably going to have a more successful company. And I see that movement to where you can have more open communication and more access to more information. That way it becomes more transparent. I think will only increase investing and make it easier for limited partners to get involved and understand what they're getting into. So I see it only getting better, but again, I'm very optimistic and very positive. So I have to stick with that.
Well, I like your mindset. Be positive always. Now, I would like to come back a bit to the gut feeling because I was used in the past to not listen my gut feeling, and I did some bad investment. On the other hand, I was used to have a good feeling about some investment, but due to the fact that maybe the data didn't look pretty fancy, I didn't invest and I lost actually the opportunity. You mentioned that you don't really own gut feeling so much, but I would like to know, do you balance somehow the gut feeling with the data or the gut feeling with, I don't know, the people you know and the experience you have had in the past with them? How do you do with this?
Well, you balance it out by, it depends. Some people, a lot of times you have your intuition and your gut feel that, something doesn't feel right. A lot of times there's a reason. It might be because of that person or something is going on.
Yeah,
Your
here
friend
is
there.
Isha. Yes, good. She's always here with me in my podcast. So if you
Nice.
don't see me, that sitting down on my legs. Now she wants to jump a bit. Sorry.
Nice, but no, that's okay. But the gut feel, there's a lot of times it'll cause you to make questions, but go back to the data, go back and redo the due diligence. Maybe you have to do it again because something's not right. There's a reason why you have that gut feel, but if it's somebody that like and trust, maybe you need to do some further investigation, ask them more questions about what we're getting into and everything else. And that way you can make a clear decision because you don't want it to be an emotional one. You want it to be a logical one. And we all have, especially if you feel it's a great deal, you might be on a heightened state where you might miss a couple of things. But if you see something you're not really sure about it, you're probably going to be a little more intense about what you're going to look at. But register those emotions and use them to double down on the data and the people you're getting involved with.
Yeah. So always data is important, but I feel somehow that if we have a certain feeling about an investment, based on the experience I had in a positive and
Yes.
negative way, you should go
Yeah.
further with it.
Yeah, I've done it. I've done it too sometimes, and I've just gone for it. But again, it wasn't other people's money; it was my own thing. And some of them did very well, and others of them did not do very well. But you have to. Everyone has their own risk tolerance and their own feel. But double check the numbers if you can. Sometimes that'll help you stay out of trouble. Yeah, a lot of times it will, because anybody can make something look great on paper, and things can always look good on paper. But if you can dig deeper, and if you dig deeper and you have that gut feel that's going to be great and it looks even better, then all the better.
So, indeed, it's right. Now, I'm scrutinizing deals, sometimes looking directly in social media, on LinkedIn, Crunchbase, and so on. And I see founders which are very open to showcase their startup, and I'm looking to make a deep research about their startup. For me, it's very important to have a personal brand as a co-founder or founder of a company.
Yes.
Is it important for you as well?
It can be. It depends on the business. Like the development partners we're involved with, they don't necessarily have a personal brand, but their track record is 3 decades. So it's not so much important in that case, but to develop that, and it will make investors feel a little bit easier if they know who they're getting invested with. It'll only accentuate the track record, but it can vary. But there's where I've met people in person, and that really matters, the in person, because building out your own personal brand, if someone does have a personal brand and you look and you can find out a lot about them, that will carry quite a bit of weight. And I do look at that as well. But sometimes, especially if people are a little bit older and have been around for a long time, they may not have built out their personal brand that much because they were busy building out their business, and they didn't really see or feel they had time for it. So it can be a mix.
Okay. Yeah. I like to see your perspective in these regards, and indeed, maybe I'm sure that there are a lot of companies or ventures which are not very open to showcase themselves, or due to the fact that they
Yes.
are older, they are not in social media. But for me, it's important, and it's
Yeah,
a
it is.
white ball, let's say, for for me.
Yeah, it's important. I think it's important to me, but some companies take a different approach where they don't necessarily want the liability of a lot of their things being out there. It can go both ways for them. There's where your own due diligence comes in. You have to find out everything you can about what you're getting into.
Great. Now tell me, what surprised you the most when you talk with general partners? Give us, I don't know, some examples in a positive way. Somebody who surprised you, which maybe at the beginning didn't look like a very interesting investment, but in the end they really surprised you and you decided to invest in.
Well, I would say probably my first limited partner. I had looked at probably about 20 different limited partnerships and talked to a lot of people, and uh, a lot of them immediately they just went into the numbers and started talking, and it can get pretty overwhelming, especially being new to that type of thing, and. But what ended up happening was that I had several conversations with a few people, and I narrowed it down. And it was more about the person that sat down and gave me the most education about what I was getting into. And then there was no pressure there. They said, "Well, look, it doesn't have to be now. It can be next time. We have things going on all the time, so." You feel free to keep asking, and I'll keep checking back with you. And there were the returns weren't as good as a few of the other ones, but they were better than some. It was kind of in the middle. But since then, since I did eventually invest in that one, it's been steady. Every quarter I get the return, and it's been better than I anticipated.
So there are also happy ends. Now I would have some quick questions to end this session with energy. So tell me one thing that general partners should stop doing when pitching limited partners.
One thing is don't immediately start pitching the deal or email it out. Get to know the person that find out what they need. What you're trying to pitch them with may not have any relevance in their life. It may not be what they need, and listen to what they have to say. Listen to what they need. That would be, so stop just pushing the deal out on everyone until you get to someone. Try to attract the people that will be good for that deal and that will benefit from what you have.
Great. What's the most overrated buzzword in venture capital right now?
Oh, conservative underwriting.
What does it mean?
Oh, everyone says we're very conservative with our underwriting. That we're very conservative, but yet when you look at, everyone was saying those same words several years ago, and you see in real estate a lot of these deals are falling apart now with the rates and loans being reset, and all of them said very conservative underwriting. They underwrite the deal to where it shows that it's going to hit all the targets over a certain amount of time, and we're very conservative because we took all these things out. But when you look at it, if you really dig deep into it, it was just they paperworked it and did the numbers to make it to where the deal would look good.
Interesting perspective. In just 3 words, what makes a general partner unforgettable?
Unforgettable. 3 words. Long track record.
Okay. What was the first fund you ever backed, and what convinced you to jump in?
The first deal that I went into was actually the one I was speaking of, and it was because of the person that they kind of listened to where I was, because I said I wanted to be a general partner, and they explained to me, well, look, you're working full time right now, and it's a full-time job, so make sure this is what you want, because it's going to be a lot more involved than you think. It's going to be like having another job. It's very time, it takes up a lot of your time. Whereas if you're a limited partner, it shouldn't take up much of your time at all, really. And because they explained it to me that way, it convinced me. Well, it didn't really convince me, but it was mainly because of the person. They took the time to explain things to me, and wanted to make sure that it was the right thing for me.
Great, awesome. We are almost in the end. I would like to ask you, where can people connect with you, whether it's online, at events, or through platforms?
Okay. Well, the easiest way to find me is investwithscottkidd.com. All my social media is there, newsletters, podcasts, everything is right there. If you need to find me, everything you need is right there.
Amazing, Scott. Thank you very much for your time. It was very nice to talk with you and to find out your perspective about investment as a limited partners. For the one which are watching us, please leave us comments, and we will try to cover your question in our next episode. See you soon.